Okay, so we are seeing a positive start to the Monday session so far. We'll see how the week plays out. The TSX right now up about 20 points or 0.1%. The S&P a little bit stronger. I say that because we've got a lot to watch on the economic front, including some key inflation data coming in this country tomorrow. We've got a lot of earnings stories. And, of course, we continue to watch what happens between Israel and Hamas. And I want to bring in Bryden Teich of Avenue Investment Management for his perspective on, boy, another wild fall playing out here with so much to consider. I mean, how are you viewing all this?
Yeah, I mean, in all of our sort of past conversations, the one thing we always wanted to highlight was just the uncertainty heading into this particular period of time. I think the unfolding geopolitical events make that even more uncertain, of course, as horrific as that is. And I think, again, it moves back to, you've got the Fed again at the end of the month. They've not backed away from the idea that there's potentially still one more hike into the end of the year. And interest rate curve is already doing a lot of that hiking for them. Maybe some comments last week were suggestive that they might be closer to actually being officially done. But I think all of that creates uncertainty now heading into, at least the next month.
You like to dig in deep and find individual stories that catch your attention in the market. When you have all of these big macro stories playing out, can you do that as effectively as you'd like to? Can you just avoid some of the noise?
I think that as a sort of long-term investor, I think what's important to always do is accept what you don't know. And to say, we don't try to sit and forecast what's going to happen over the immediately short term, but we try to find what we think are good businesses for, a long-term horizon, while at the same time accepting the uncertainty of the moment at any given time. And if we're paying a reasonable price for a business, we're happy to do that in almost any environment. And so I think in some of the previous times we've spoken, really trying to understand the durability of earnings through the next, several months and quarters is critical to us to know what kind of companies we want to own here, regardless of the uncertainty in the exact moment.
Well, we can highlight for our audience, you just got so many companies reporting this week. It skews a little heavier in the U.S., but everything from, these big banks like Bank of America, financial players like Goldman Sachs, to Tesla and Netflix that will all be reporting their results this week. When you're looking at let's say a company that is in your fold ends up reporting, what are you looking at? Are you looking at how they do in the third quarter versus expectations? Are you looking at what they say about the outlook? Are you looking at some other metric on the balance sheet? Any combination of all of that?
Yeah, I'd say a combination, but I would say we definitely skew towards the outlook of what they're expecting going forward and what gets reported. I mean, oftentimes you'll have a company have terrible earnings, but if they report good outlook, the stock will be up. And so sometimes the confusion is, well, they had bad earnings, why did the stock go up? But it's always about sort of looking forward. I think the other thing we try to do in particular is own businesses that we're comfortable not relying on any given quarter of results. And I think one of the most sort of uncertain things or things I don't like is when I have to worry about a quarter. That's an indication that it's almost an investment that we shouldn't be making, because we don't want to be owning stocks just based on what they do on an individual quarter. So we evaluate things on a much longer time horizon, and we're not really focused on quarter to quarter. But if we were to pull something away, I think the outlook is always something that we're most interested in listening to.
Okay, well, we got a lot of businesses in this country that have been around for a long time, and they are sort of the bread and butter of what the TSX represents. That would include some telecom companies, and we're part of one of them. But for your stock ideas today, you brought TELUS to the table. And actually, I was listening to one of our veteran guests, David Baskin, earlier this morning, just highlight that in this environment where investors had so aggressively sold bonds and that pushed up bond yields, that companies that pay dividends were fighting for attention with other investors. And just looking at TELUS's performance this year, it has been a tough year, but that catches your eye. Yeah,
so we bought TELUS last week. I think what we've been trying to do is go through, I would say, in the Canadian stance, what's been the most beat up things, and is there a reasonable argument TELUS was down, 18% on the year. At some level of valuation and yield, it's got a very predictable, durable business. They've got a great franchise in Western Canada. In many ways, we were lucky to have not owned it previously because it gave us a chance to buy it last week at a really great level. It's not to say that, we can't just sort of hold or bounce lower from here, but I think it's an example where we think the risk reward is really attractive in the midst of other things where there's uncertainty in other businesses. We think TELUS at these levels is a great great chance risk reward for us.
Okay, another one that you wanted to highlight today is First Capital, which, there's all different flavors of real estate investment trusts. I believe this company is tied to a lot of grocery stores, like those are the anchor tenants for their properties.
Yeah, so specifically on First Capital, what we were highlighting is actually the First Capital bonds.
Oh, okay.
And so I think one of the things we're finding as really attractive here versus, let's say, a year ago, was that as interest rates were pushing higher, the absolute level of interest rates in corporate bonds was still not jump off the page attractive, but with short-term government interest rates, say at 5%, to be getting 5.5%, 6.5% in a 2-year really defensive bond, we think is an attractive place to be hiding out, waiting for all of this uncertainty to resolve. And it got to the point a week ago where internally we just said, let's have a conversation about where absolute yields are in the corporate bond market, because you have to accept that 6 or 6.5 yield for a 1-year piece of paper, that's, to your point, grocery anchored. I mean, that's starting to get really attractive in the midst of potential earnings recessions and all the other things out there related to equities.
Because we had a viewer call this morning where it was more on GICs. And so I guess if people are thinking GICs versus buying into some government bond, you could extend that conversation to be versus buying into short-term debt from a company that's pretty reliable.
Yeah, no, exactly. I think the biggest argument against GICs, like let's say someone says, I don't want to be in equities, but I want to be in GICs, but I want to buy stocks when they're cheap. The problem is there's a lockup with many GICs.
Right.
And they're punitive. It's sort of punitive liquidity where either in a T-bill, short-term government, or even a short-term corporate bond, you can have the ability to sell those, reinvest in equities while being paid. And I think it's that if the goal is to lock up money and forget it, I mean, GICs are okay, but it's the reinvestment of the GIC that I think people don't always appreciate, when comparing them to bonds.
If you want to be active. And we got a lot of people who are active
sure
who are
you do.
watching every day. We appreciate it, Bryden. Thanks very much. Bryden Teich, partner and portfolio manager at Avenue Investment Management.